Hi everybody, it's Ryan here, and today we're going to be looking at exchange rates and the factors that affect exchange rates. By the end of this lesson, you should be able to use the key terms regarding exchange rates and be able to explain the factors that affect exchange rates. To begin, the definition of an exchange rate is the price of one nation's currency in terms of another currency. I often use xe.com to look at the pound sterling versus the US dollar. And if you look at over the course of over 10 years, actually, I like to splice these graphs together because it goes back to show me the days when the pound was super strong against the US dollar. Back in 2007, early 2008, it was actually over $2 to the pound, followed by quite a large slump following the financial crash, and then it's sort of hovered around $1.55 since then, up until the Brexit referendum when it sort of came back down again, and then it's been sort of steadily climbing up to the beginning of 2018. Another useful website you can use to explore exchange rates is the BBC News website. They have a little pound tracker, and this is really good because even in the past few months you can see what's happened. An appreciation of the pound here in October 2019, and then actually a very, very steep decline in the pound in March of 2020. And you can use this to sort of play around and look at sort of over a 1 day, 1 month, 5 year sort of horizon. Some of the terminology that you want to know is that appreciation means that a currency gets stronger compared with other currencies, whereas depreciation means that a currency gets weaker compared with other currencies. The way you can use this when you're looking at a graph is if you're looking at the currency in the price of another currency, that is to say, how many dollars do you get per British pound? If the number of dollars per pound is falling, as it was from 2014 to 2016, you would say that overall that's a period of depreciation of the pound. But then if the number of dollars you can buy given your pounds rises, then you could say that is an appreciating pound. To understand what affects currencies, we have to have a model and understand how it is that exchange rates are determined in a freely floating system. So in a freely floating system, exchange rates are determined by supply and demand, and they are traded on FOREX markets. A FOREX market means that it is part of usually a large institutional bank where they're going to have a FOREX floor, where they're going to have lots of traders like you'll see here that are buying and selling currencies from each other. They will be calling up other people in other banks and saying, hey, I've got so many pounds, I've got so many shekel, I've got so many rand. What kind of price can you do for me on this? And trying to find a buyer if they are selling, and trying to find a seller if they are buying. And you often will think about them in big financial institutions like in the City of London. The City of London is a major trading center for lots of global currencies. To understand what a Forex market looks like, I would highly recommend having a look at this video. I'll put the link in the description. It's a guy who works at a Forex trading floor, and he spends all of his day trading. And you can see him here. He's, I think, putting forward a bid for selling or buying Israeli shekel. To understand what the exchange rate market looks like, a useful task is to think of the buyers and sellers that are actually in this exchange rate market. So to begin with, who is demanding pounds? So the people who are demanding pounds are people who want to buy British goods. If you're buying a British good that's exported from Britain, the manufacturer needs to be paid in pounds because that's their currency. And so therefore, if you are buying British goods, if you're buying British exports, you are going to be demanding those pounds. Other people who are going to be demanding pounds are people who want to invest in the UK. We call this capital inflow. One part of capital inflow, which is going to be very important, is called hot money. This is the temporary slosh of funds that goes around the world seeking the highest return, and we'll talk about how that's important later. And another one is, of course, inward foreign direct investment, or FDI. So if people want to buy British goods, or they want to build in factories in the UK, they want to invest in the UK, then they are going to be demanding pounds. The people who are supplying pounds are British people who want to buy foreign goods, who want to import things. So think if you wanted to go on holiday, or if you wanted to buy a good that was manufactured in China, you have pounds, you've been paid in pounds, and what you're doing is you're saying, I want this thing from another country, so before I can buy that thing from the other country, I need to sell these pounds. So British people, and you in that case, would be a supplier of these pounds. Another source of supply for pounds are investors in the UK who want to invest abroad. This is called capital outflow. Again, it can be referred to as hot money. So hot money can be part of this capital outflow, or it could be outward FDI. If an investor wanted to build a factory in, say, the US or China, they would have lots of pounds that they have in their pocket, but they want to be able to buy the Chinese yuan or the US dollar in order to build that factory. Because foreign currency is traded in a market, we're going to set up a model that can determine the price and quantity for this foreign currency, just like we've set up any other model before. And so again, we'd have the X and Y axis, and we'd label it in the market for pound sterling in this case. We'll label the axes. To begin with, the y-axis, which we usually have as price, we're going to say is exchange rate, or E. And that's in terms of the number of dollars you can buy per pound. So the y-axis is the exchange rate. And then the x-axis is the quantity of the currency traded. We usually say quantity on the x-axis. In this case, we're just interested, well, how much currency is being traded? To be honest, that's actually not going to be so important when we're trying to determine the exchange rate for any given situation. The next important thing is to then conceptualize and to label our supply and demand curves. The first one, as normal, is the demand for the currency. Now, in this case, we can say it is the demand for the currency. But as we said before, it is equal to our exports. It's also equal to our capital inflow. So these are the people who want to demand the currency, and labeling it in this way will help us to manipulate this graph to show the way the different things affect the price of currencies. Next, we'll want to put on the supply curve, and that is, again, as we know, supply, but we'll want to label it by saying that this is equal to imports or equal to capital outflow. So again, to help us to understand and determine who it is who's actually supplying this currency. And then like any other market diagram, we'll say, well, this is the price. The price is E1, which means the exchange rate at that level, and then quantity 1 as normal. So just your basic market equilibrium diagram, but with some new labels for the supply and demand curves. What we want to be able to understand then is what causes an exchange rate to appreciate or depreciate. And the things that I want to focus on are interest rates, trade flows, confidence, safe haven issues, and speculation. And we'll go through each one of those in turn. First, the effect of interest rates. This is a very important line of analysis that you'll want to really, really know well, because it will be really handy when you're analyzing the effect of interest rates on exchange rates. So to begin with, we say, number one, maybe the UK interest rates increase. This is a picture of the Bank of England. They set UK interest rates. So if UK interest rates increase, think about what effect this has on the rest of the world. In this model here, American investors, but not just American, people from all over the world, are going to want to put money into British accounts to take advantage of these higher interest rates. As a result of this, hot money pours into the sterling market. It's really important to use that term because that is the technical term of the type of money which is going around seeking the highest return short-term capital flows, and that pours into the sterling market. And as a result of this, the demand for pounds increases, and because of the increase in the demand for pounds, we would expect the pound to appreciate. To model this using our model, we'd say that if following the increase in interest rates, we see that increase of demand because hot money has entered the sterling market, that's going to push the demand for sterling to the right, and we will see an appreciation in the exchange rate. Next is to look at the effect of trade flows. In this case, we'll break this down into two different categories. First one, talking about exports increasing. So if British exports are seen as desirable or useful, what this is going to mean is that foreigners demand our products. Maybe it's a bunch of people in the US wanting to buy dual-lit toasters or go on holiday in the UK because Downton Abbey's been a really successful program or something like that. The point is that these people, foreigners, are demanding our products. Therefore, to pay for these products, they must demand pounds. This means that the demand for pounds increases, and as a result, we see our currency appreciating. So if we increase our exports, or if our exports become more desirable, we can expect an appreciation of our currency. Likewise, if our imports increase, if British households increase their imports, this means that British households are then selling pounds onto Forex markets. This pushes up the supply of pounds. It shifts the supply of pounds to the right. And as we can see from the diagram, therefore, the exchange rate, the pound sterling exchange rate, will have fallen. So we can say that the pound has depreciated. Next, let's talk about confidence. Now, confidence means that foreigners want to have their money in the UK, either put their money into UK assets, or maybe they just think that the UK is going to be a place with strong economic growth, somewhere where they want to have assets in the future because it's going to be a place where that strong economic growth is going to transfer into higher incomes. And so if foreigners lose confidence in the UK, well, this means it's a less attractive place to invest. So people would not want to build so many factories in the UK. This means that there's lower capital inflow into the UK, which is going to shift the demand for pound sterling to the left, and we will see a depreciation in pound sterling. A useful illustration of confidence in the UK affecting exchange rates comes on the night of the 23rd of June 2016, which was the night of the Brexit referendum. I've got a snapshot of what happened to the pound sterling over that period. And as you can see here, early on, it looked like it was going to be a Remain vote. A lot of the institutional investors, they were hoping for a Remain vote because it was a sign of stability. It was a sign of the things which people were used to. And so they thought, okay, it looks like it's going to be Remain. That's going to mean that the pound sterling is increasing. But then as the results came in, it was confirmed that the Leave vote was the winner of the referendum, and so therefore the pound all of a sudden had a big depreciation. Lots of people in forex markets around the world were suddenly selling their pounds, which meant that there was a depreciation from $1.45 to $1.30 in the period of a couple of hours. Another good example of when confidence has affected UK exchange rates is looking at the general election of December 2019. This is a news article from the Time. Pound and shares surge. The headline is that the pound and shares have surged after the Conservatives won a clear majority in the UK general election. After months of political uncertainty, it was very clear that Boris Johnson and the Conservatives had a very strong government going forward. And as a result, when the election results came in, the pound saw a sudden spike in its value against the dollar. Another example of when confidence affected the UK pound, looking at this one here from the BBC. If you look in October of 2019, the pound was fairly weak against the dollar, and then it had a sudden climb and it remained strong against the dollar after the October 2019 talk between Boris Johnson and Leo Varadkar of Ireland, when it became clear that there was going to be a Brexit agreement and that they were going to be able to have some sort of exit strategy for the Brexit impasse. Another factor that determines exchange rates are safe haven issues. If a currency, say the pound, is seen as a safe currency, then in times of uncertainty, investors will want to put money into this currency. As a result, demand for the currency will rise. We see a shift to the right in the demand for the currency, and so therefore the currency appreciates. It's difficult to find really good examples of where you can find safe haven issues being something which affects currencies, but in March 2020, there was a really good example of this because as a result of the coronavirus uncertainty, all investors around the world suddenly flocked to the dollar. The dollar was a really safe currency, and so therefore the dollar had big appreciation against most of the currencies. Seen here, the pound to dollar exchange rate is a sudden fall over the course of one day in the value of the pound. Another BBC News article on this topic was talking about the fact that the pound has fallen to its lowest level against the dollar since 1985 as the spread of the coronavirus pandemic spooks investors. The main point of this article, though, is that you can see this is about the US dollar, which is proving unstoppable as global financial markets stare into the abyss of crisis-like conditions. And it's very good for me when I see that the economics editor of the BBC talking about safe haven issues. I'm thinking, great, this is exactly what we want to talk about for A-level economics. Another graph I like to use when talking about safe haven issues, this one is from an Economist article in 2017. Looking at this here, it's talking about the VIX Volatility Index. This index measures volatility of global markets, so how uncertain are global markets. In safer times, there will be a lower VIX index. And so what this means is that if you have a 1-point fall in the VIX index, it means that the global markets are becoming more calm, more secure, and so therefore more investors want to purchase these risky currencies. Currencies like the South African rand, the Brazilian real, Turkish lira, Mexican peso. These currencies see an appreciation following more certain times in the global economy, whereas safe haven currencies, things like the Indonesian rupiah, the Philippine peso, Thai baht, Taiwan dollar, Swiss franc, they are less affected. You can see that there's a less of an impact on those currencies of a fall in the VIX index. And some currencies like the Japanese yen, which you would assume would be quite a safe currency, they actually see a depreciation because of the fact that we have safer, less volatile times. Another factor that affects exchange rates is speculation. Now, speculation means that you are buying something because you think its price will change later. You are trading to make a profit. I include this picture here of George Soros. He is a famous speculator, most famous for his role in the Black Wednesday crisis of 1992, where he made $1 billion in one day speculating against the Bank of England. And we'll look at that in another video, but he's a really good person to think about when you want to have an example of someone who's speculating. So with speculation, to model this, if you expect the price of pounds to decrease, well, you don't want to be holding on to pounds if you think that all of a sudden, if tomorrow or the next hour, they're going to be worth less money than they are currently. And so what you're going to do is you're going to want to sell those pounds. So if you sell those pounds, or in the case of speculating, you would short sell them, so which means that you're borrowing pounds from somebody else to buy them back later to make a profit. What that's going to do is that's going to increase the supply of pounds on global markets. So the supply of pounds increases, and so therefore the pound depreciates. You will notice that it's a self-fulfilling prophecy, and that's what people don't like about short selling, is that by short selling pounds, you are actually causing the thing which you expected to happen. You expected the price of something to go down, so you sell it, and so therefore the price of it goes down. And so speculation, that's why sometimes speculators get a bit of a bad name. If you are speculating and you expect the price to increase, then what you want to do is you want to purchase those pounds. You want to have something, you want to buy it now because you'll be able to buy it for cheap, and later on it will be worth more money. And so therefore you buy as many pounds as you can before the price goes up. By you getting into the market, by you calling up your currency trader and saying, buy me pounds, you are increasing the demand for pounds. By increasing the demand for pounds, it shifts the demand curve for pounds to the right, and so therefore the currency appreciates. Again, the same self-fulfilling prophecy as we saw with short selling of pounds. So there you go. That's all the theory that you'll want to know about what affects exchange rate diagrams. You want to make sure you have really good notes and understand those different factors that affect exchange rates, especially the things like interest rates, hot money, and the way that exports and imports can affect currencies. Thanks for watching. I hope you found it useful. If you did, please make sure that you give it a like and make sure you subscribe to this channel for more videos on economics content.